Facebook filed an S-1 form with the Securities and Exchange Commission on February 1st, taking its first big step toward going public. It aims to raise $5 billion through its upcoming IPO. Looking at this S-1 form, we can see that Facebook's revenue climbed from $777 million in 2009 to $3.71 billion in 2011. We also see that its annual profits went from $229 million in 2009 to $1 billion in 2011. Its profits grew by 65% last year alone. Its top source of revenue is advertising. 12% of Facebook's 2011 revenues came from Zynga, a social networking gaming company. The Google IPO, to contrast, raised $1.9 billion, and this IPO could potentially dwarf that. The question that everybody seems to be asking is, will this IPO live up to all the hype? And the answer is it might and it might not. Let's examine some other key tech IPOs and see how those shares have done ever since. First one, Google. The IPO set the share price at $85. Here in early February 2012, the share price is now around $580. A home run by anyone's definition. LinkedIn. On the day of the IPO, the share price climbed from $45 to a peak of $122.70, and then settled on the day at $94.25. At the start of February, LinkedIn was trading for about $72 a share. Then there's Pandora. Shares were offered at $16 in June last summer. 8 months later, they're trading at about $13 a share. And then Zillow. Shares were offered at $20 in July last summer and ended at $35.77 on the day of the IPO. In early February, Zillow traded around $30 a share. All in all, these numbers look pretty good, right? Well, sure they do. To institutional investors, though. Keep in mind that the little guy gets their second. It's the institutional investor, not the small investor, who gets first dibs on the stock and who frequently realizes the terrific upside. The individual investors get to get in after the shares take off. Sometimes they pay a price. So what are some lessons that we can learn from the dot-com or dot-bomb years? The 1990s may seem like ancient history, yet there are examples from the past worth noting when it comes from IPOs. There's a finance professor by the name of Jay Ritter at the University of Florida who's maintained a huge database on IPOs for decades. He did a study of just over 1,000 IPOs from 1988 to 1993, and these were all IPOs that raised $20 million or more. And what he found is that the median IPO underperformed the Russell 3000 and index by 30% in the first 3 years after going public, and that 46% of the IPOs produced negative returns. In 1999, 555 firms went public, and the median share price gain for these issues on the day of the IPO was 30%. But what if you bought after the first day? If you did, the median gain after 3 months averaged 0%. Additionally, almost 75% of all U.S. internet-related IPOs from mid-1995 to 1999 traded underneath their offering price at the moment of publication. So, should mom and pop dive in? Well, as MarketWatch columnist Mark Hulbert pointed out, Facebook's IPO will be 3 times as expensive as Google's and about 40 times as expensive as the average large IPO since 1975. As Hulbert found in the wake of a chat with Professor Ritter, Facebook's price-to-sales ratio looks to be about 26, with 2011 revenues of $3.71 billion and a reported IPO valuation of about $100 billion. Google's price-to-sales ratio was 8.7 at the time of its IPO. Looking back, Ritter found 76 companies since 1975 with trailing 12-month sales from the date of their IPOs of $3 billion or more, and that's in 2011 dollars. Firms with more or less reliable revenue streams. Their average price-to-sales ratio was 1.0. AT&T Wireless was the highest of them at 8.9, and that was a 2000 IPO. So in other words, Facebook would need staggeringly high revenues or a consistently remarkable profit margin for its shares to behave as well as Google shares did in those first few years out of the gate. Could the tech sector see a Facebook effect? Yes, remember the wealth effect of the Google IPO? Some of the best and the brightest in the tech sector became overnight millionaires and went off and founded their own profitable firms. That sort of thing could happen again. There are tens of thousands of startups now generating revenues off of Facebook's platform. So you have a whole ecosystem of smaller firms that are anticipating the IPO as much as institutional investors. Caution might be in order for those awaiting Facebook's IPO. Individual investors have swung for the fences many times in situations like this, only to strike out.